A number of legislative proposals have included an elimination of the step-up in basis and a change to more of a carryover basis regime both during life and at death for transfers as part of an estate plan. There could also be increases to capital gains rates and maybe even a deemed disposition tax. A number of these proposals may create new duties or enhance existing duties for trustees of trusts in a couple of ways. One, there may be an enhanced duty for trustees to obtain basis information which they might otherwise not have needed to obtain, and that basis information may need to be made a condition to accepting trust property, which could be coupled with indemnification for reliance on a transferor's basis info. Another issue that could come up is a change in capital gains rates. Might there be enhanced duties to trustees to, instead of allocating capital gains to principal, instead allocate those to income so as to save income taxes with respect to the trust and beneficiaries, especially if the grantor has expressed a precatory intent to save taxes. And of course, all of these duties must be balanced with the offsetting duty to protect against creditor claims, especially given that the IRS could be a creditor of the trust or beneficiaries. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 203, we're just looking at trustee duties in a carryover basis world, which could be enhanced, it could be the same, it could ignite maybe new trustee duties. It's hard to know until we get certainty on legislative proposals, but there could be some drafting issues and administrative issues that are helpful to get the ball rolling on in advance, just in case there are legislative changes. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. So, one of the biggest hot-button tax issues in a number of legislative proposals has been the elimination of a step-up in basis for assets that are owned by a decedent at death or subject to estate tax at death. And this would be replaced by more of a carryover basis regime. Now, within that, there could arguably be some room for an increase in carryover basis, maybe proportional to any gift, generation, skipping, transfer, or estate taxes that are paid at the time of the transfer. Could also be a deemed disposition like they have in Canada, which would establish a new cost basis. Now, in any of those situations, one common theme is that with a carryover basis, there could be new duties imposed on trustees to determine what that basis is. Now, a number of you may be asking, isn't there already a duty? Well, the current environment is that trustees typically only have to worry about carryover basis in a relatively rare scenario where there is a non-grantor inter vivos trust created by the grantor and funded by a gift. Now, why is that? Well, a number of the other funding mechanisms shift the basis obligation to an individual. So for one, if a grantor created a trust, then any income tax event would be taxed to the grantor. So it's on the grantor then to track basis and incur income tax on behalf of the trust. Similarly, if a trust is funded at death, if it's a testamentary trust or a pour-over trust, then there's usually a step up in basis for the assets, and the duty is shifted to the estate or the estate of the individual to determine fair market value and also determine the stepped-up basis. And three, if there's a sale of an asset to a non-grantor to determine what the basis of that asset was, and the asset in the hands of the trust is going to get a new stepped-up cost basis. And in that situation, a lot of the tax headaches are shifted to the selling grantor. For example, if you're looking at installment sale deferral versus immediate recognition of gain. But given this rare scenario where trustees have to know basis, we're going to eliminate a lot of those individual circumstances where the burden is shifted to an individual or to the estate. So, because of this, there's going to be a new enhanced duty for trustees to be informed of and obtain information regarding carryover basis when a trust is funded. And if the trustee were to breach that duty, what that means is that in the worst case, there could be zero basis to the trust, which increases the income tax and impairs the economic benefits to the beneficiaries. That's a bad outcome. You don't want that, and a trustee doesn't want to be sued for these types of things. So if there's any sort of individual transfer income tax that's imposed on a donee or beneficiary or an estate, trustee might also have to track that as well to make the appropriate adjustment to basis, or to argue that there should be a new cost basis in the hands of the trustee with respect to that transferred property. So that being said, how far does this authority extend? One issue with this is that, for one, the transferor is usually the one responsible for gathering this information and then providing it to the trustee. So does the transferor have any sort of obligation to do so? Arguably not. A transferor doesn't have to share tax returns or anything with the trustee, so that may be a drafting issue to address within trusts, and there may be more of a duty or a sub-duty to this for a trustee to say, hey, I have the ability to reject trust property. So if I don't have the appropriate basis information, do I need to reject the trust property unless and until I can get that appropriate basis information, and create a condition where to accept trust property on behalf of the trust and beneficiaries, I must get basis information for that carryover basis. That could be something that you have to deal with. And with that too, what if the basis information is wrong? What if it's just fabricated by the transferor and pulled out of thin air? Can the trustee be liable in that circumstance, and to what extent can they be indemnified? And arguably, you can get indemnified as a trustee for a large number of things, and especially this would be a scenario which is ripe for that, because the trustee is so dependent on the transferor's representation of basis here, especially for hard-to-value assets. So, doesn't mean it's easy or administratively efficient to do so. Usually, so long as the trustee, at least in UTC states, doesn't act in bad faith or with reckless disregard for the trust instrument, they can get that indemnification. That would rarely be the scenario with this basis piece, but arguably there could be bad faith if the trustee just fabricates basis information. But, that aside, there is the nightmare of having to obtain indemnifications, especially midstream from beneficiaries, whether it's in person or by virtual representation, especially once the trustee has accepted trusteeship. So, as an ongoing piece, in addition to drafting around this issue within trust, you may need to look at this as part of trust onboarding, that if you are a trustee, you need to get the proper indemnification for any transfer or representation of carryover basis. Now, that aside, there's been some talk about changing capital gains rates. In some cases, individuals, maybe with over $1 million in net income or AGI, are going to have long-term capital gains rates taxed as ordinary income, essentially at a new federal highest income tax rate of 39.6%. Now, as is the case with trusts, that may have the same effect on trusts, but at a much lower income threshold. There's not enough information out there on current legislative proposals to spitball that, but because of that, the big question is too, with that change, does that enhance the duty of trustees to allocate capital gains between principal and income? Which is under the Uniform Acts, the Uniform Principal and Income Act adopted in most states. That is a power that the trustee has, but does that power impose a duty as well in a changing capital gain rate environment? Right now, typically, capital gains are allocated to principal and taxed to the trust, but that tends to be of no consequence because the highest long-term capital gain rate is the same between a trust or an individual. But it might not be in the future, especially when you look at rate disparities and bracket disparities and things of that nature. So, If the trustee has an additional duty to distribute principal for income tax savings, that could be an ongoing issue that needs to be addressed in the future. Now, I note that a number of trusts have precatory language oftentimes where the trustee or doesn't necessarily have to follow it, but it is an expressed intent of the grantor to save income and maybe even transfer taxes within the trust. So looking at that holistically, would that create a duty on the trustee to distribute principal in the form of long-term capital gains for income tax savings, coupled with the 1041 election to allocate capital gain to income and instead of allocating it to principal? That could be the same case too, where maybe if there's a deemed disposition tax, within the trust, is there a duty to get assets out of that trust so that they aren't hit with that deemed disposition in the hands of the beneficiary as opposed to in the hands of the trustee? And similarly with changing estate and GST tax rates and exclusions, there may be an additional enhanced duty to get assets out of the trust and into individual beneficiaries' hands in order to save, for example, GST tax in the future. So there's a number of issues here in terms of trustee duties that could pop up, not just for basis tracking, but also for saving tax within the trust. And of course, all of those have to be balanced with the fact that assets of the trust are no longer protected from claims of creditors once distributed. So how do you balance that? Especially if there's a competing precatory intent to protect assets from creditor claims above and beyond just what's provided by a spendthrift clause. So these are all crystal ball issues, but they're things to think about when drafting a trust or accepting trusteeship if you are a trustee who's onboarding a new trust. As always, if you have non-client related questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.